Welcome back to Beyond the Audit, the podcast where we go beyond the numbers to explore the latest developments and trends in the finance world. I'm your host, Luphumlo. In our last episode, we introduced the third edition of IFRS for SME Accounting Standards and explored the reasons behind its updates. Today, we are continuing the conversation with Karolina Martin, IFRS Director at Forvis Mazars, as we dive deeper into the practical implications and key changes in this new edition. Karolina, thank you for joining us today to continue this important discussion.
Hi, thanks. It's great to be back.
In the previous episode, you mentioned that there were some new changes in the statement of cash flows, specifically relating to supplier finance agreements. Can you briefly explain to us what supplier finance arrangements are?
So this is something that is quite common across the industry or different types of industry. So basically a supplier financing arrangement is where a manufacturer, for example, has got suppliers with terms of 30 days and then they will approach a finance institution or supplier to pay that supplier off quicker, and then they will then owe that money to the financial institution or service provider.
And then what do you think the new cash flow amendment will add to the SME reporting under the new IFRS for SMEs Accounting Framework?
So the new amendments under the IFRS for SME on cash flow is more from a presentation perspective. So one of the notable ones that we spoke of now was the supplier financing arrangements, but this is expected to provide more transparency for users in terms of how an entity is actually managing their cash flow, especially around supplier financing arrangements.
Oh, that's interesting. So it's more in line to what was managing the working capital of
Correct.
each entity.
Yes,
Perfect. And then just want to understand how do you think these changes will impact the people that are preparing IFRS for SMEs financial statements?
So it is a presentation and, like I mentioned, disclosure. So preparers will need to just provide further information within their financial statements. For example, what the carrying amounts of these arrangements are, what are the terms, cash flow, non-cash flow, etc. So that's basically additional disclosure that would need to come in.
In the last session, we talked about a new requirement for the statement of cash flows, the note about changes in liability from financing activities. Can you just walk us through that in more detail?
Sure. So this is based on the IFRS framework requirements. So that is an I7 from IFRS. It basically is going to provide more insight into liquidity, solvency, also from a cash flow perspective, and how an entity is actually managing those aspects, especially around their financing. So it is added an enhanced disclosure, again, a disclosure additional requirement, which will provide a lot more insight into how the company is managing their cash flow.
Coming to our last question, basically, which part do you think would impact an SME the most in terms of cash flow statement amendments?
I do believe both would impact because it is a presentation and disclosure. So it is a positive impact in the sense of a user is able to understand exactly how the company is managing the cash flows, especially from a financing perspective.
Thank you so much for your time, Karolina.
Thank you. Thank you so much.
That brings us to the end of this episode of Beyond the Audit. Thank you to Karolina Martin for sharing her insight on the practical implication and the key changes in the third edition of IFRS for SME Accounting Standards. In our next and final episode, we'll wrap up the series by discussing additional amendments and tools available to make the transition smoother. Don't miss it. Thank you for tuning in. We'll see you next time on Beyond the Audit.